Good morning, ladies and gentlemen, and welcome to the SMARTSPACE Software PLC end-of-year trading update investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Christian Shaw, CFO, and Frank Bridgemar, CEO. Good morning to you both.
Good morning. Thanks very much, Mark. I'm Frank Beechner. I'm CEO of SMARTSPACE PLC.
Morning, everybody. I'm Christian Shaw. I'm CFO.
Great. So the reason for this morning's call is we haven't spoken to to investors in general since we did the year-end update back in October, and we thought on the basis of the announcement that we made around the VOCO in the autumn, it would be good to come out and to sort of, I suppose, give an update to the more general investor community. So thank you very much for taking time to join us this morning.
Just jumping straight into the financial highlights for the year. So we had a revenue for the year of 5.3 million, 15% up on where we were in the previous year. As you can see here in the graph on the right-hand side, there's been a big increase in the recurring revenue throughout the year. So we've got a 50% increase in recurring revenue compared to where we were the previous year. That's coming both from Swiped On, you can see in the blue there, and also from Space Connect is contributing more and more as well as we go on. Corresponding to that, there's obviously a decrease in the non-recurring revenue that comes from the A&K side principally. A&K is a UK-based business which is selling hardware offerings into UK companies which have been working from home, and as a result, the revenue in A&K has obviously decreased as we go through the lockdown periods. As we exit those, we start to see things open up, and so we'd expect that to increase going forward back to normal pre-pandemic levels. The annual recurring revenue for the business increased year on year 64% to 4.9 million as of the end of January 2022. We restate our prior year numbers to the current exchange rate so you can see what the real growth is within the year. And that gives a good starting off point going into next year. You know from the broker notes that they have us market expectations of revenue next year of 6.5 million on a consensus. And so with a 4.9 million opening ARR gives us a good start going into next year. The EBITDA loss for the year was £2.5 million, slightly better than the market expectations, which were set back in October of £2.7 million. We're saying that that's the minimum loss. So put it more simply, it could be £2.4 million loss, but it won't be £2.6 million loss. We had gross cash at the end of January of just under £2.8 million. That's a burn of £600,000 compared to where we were in July last year over the 6-month period. If we look at the broker notes, they have us continuing to burn a bit of cash going into the current year, but starting to be cash generative in the year after that.
So we'll just take a trip through the performance of the different business units now. Swiped On, our visitor management system based out of New Zealand, as you'll be aware, we have customers in 70 countries, but we focus on 5 key English-speaking markets currently: the UK, US, Canada, Australia, New Zealand. We've had a very strong year in Swiped On. The ARR has increased by 57% year on year. It's actually slightly higher than that if we were to use the exchange rate at the time. Everything's been rebased to take the exchange rate at the 31st of January. So 50% growth in ARR. Which we're 57% growth in ARR, which we're really, really happy with. The other key driver in our business is ARPU, that how much money we bring in per customer per month. The higher we drive that, the faster we get to profitability. Again, I think the market was expecting we'd get to about 140 New Zealand dollars. We've actually got it to 154, and it's year on year, it's 58% up again. So. Now that's come from in a number of sources. We've been pushing through a price increase, which has been working really well. We've introduced desks, so the value of a desk customer is much higher than a visitor customer, we've been migrating people up through the plans, and we've been also looking for account extension or growth within accounts, so selling more to existing customers. So all of those activities have come together to help us execute on that strategy, and obviously going forward we want to persist with that. But to see such a growth in over the years is very encouraging, really. We've increased locations. We're less concerned about numbers of customers and more concerned about the ARR value and the ARPU, and ultimately ARPU will be driven by location. So if we get more locations, the ARPU increases, because our ARPU numbers are based per customer as against per location. Swiped on desks, we're getting good reception to that now. So and we're starting to see our first customers. Sales cycle slightly longer than visitor, because more people in the business tend to be involved. And we've actually got swiped on desk customers in all of the major regions, from Asia Pac across to obviously to the UK, and then in the US. And you may remember that the swiped on desks product is basically a reskin version of the Space Connect desks product. And we won the cross-core visitor management awards this year as well. So again, really high levels of customer satisfaction, which for us is one of the strong differentiators and something that's very defensible as well. So we constantly rank very highly in terms of G2 and a whole range of other industry monitors. When you look at these metrics, we use a lot of external data to see how we're doing, and we use a product called Profitwell, and they've created some great stats, and they show us all the time in the top quartile in terms of how we're performing as a SaaS business in general. There's something like 3,000 or 4,000 SaaS businesses in our cohort. And as I say, for us to be right up there in terms of growth, ARPU, ARR growth, ARPU growth, revenue per employee, etc., shows that we're actually on the right direction. And but needless to say, we believe that as a business we're really undervalued compared to what's out there in the market right now. But we'll let you form your own views as you see the story unfold today.
Just moving on to Space Connect. Again, here you can see good, strong growth in the ARR for the year. So we've gone from 160,000 at the beginning of the year to 610,000 at the end of the year. Customer numbers have also increased significantly. We were, I think, 11 at the beginning of the year and 69 at the end of the year, and you can see that 28 in July. So good, strong growth there. You can see on the graph there on the right-hand side how those customers and the ARR have increased throughout the year, and I think that it's quite significant that you can see as we exit the lockdown periods in July and August, there was a good strong jump in ARR and customer numbers, and things slowed down a bit in the autumn as companies continued with their work from home mandates, as the infection rates continued. But again, you can see there going into January that there's a good strong jump in ARR and customer numbers as well, again, as we start to return to more normal working from the office practices. Space Connect is suited for both small and for large customers. We've got customers paying us £1,000 all the way per year, all the way up to £60,000 a year and above that. And it doesn't really take us a lot more effort to set up a small customer. It doesn't take a lot of time because it's very much a self-provisioning product. From an ARPU perspective on Space Connect, we don't really focus on that number too much at the moment. We will do in the future, but as we build the customer base and we're still getting small and large customers come in, that ARPU is still settling down. So until that settles down, we don't focus too much on that number. We haven't had to reduce our prices within Space Connect, so even though we are bringing those small customers in, they still come in at the same price as the larger customers. We've got a good, strong partner network in place now. We've got partners in, as it says here, Philippines, Poland, India, Ireland, Canada, Belgium, the USA. We've pretty much got partners throughout the world available to sell Space Connect. Our first customers have joined us in the USA, so we've got customers over there now. From a Evoco NASO perspective, NASO is meeting the revised expectations which we put out in October. It still hasn't got to the point where it's got a regular beat to that side of the business yet, We had a good, strong few months in November and December, but it fell back a bit in January. So we haven't got to the point where we're able to say accurately where we think that growth is going to be for the NASO. We remain optimistic about it, but cautious in our forecasts. Evoco still incredibly optimistic and confident about the product. And I think that it'll take us a good 6 months of more data to be able to have revised expectations of where we think the sales for NASO will be going forward. From a development perspective, we've now moved all of our developers from Ukraine, so we no longer have any development team in Ukraine anymore. They are all now based in New Zealand, operating under our group CTO, who is based down there as well.
ANK, as Chris alluded to earlier, is based predominantly in the UK, servicing UK customers only. Of the 3 arms of the business, is the one most affected by the work from home mandates. And we've noticed, as we went through the various lockdowns last year, that business was quieter. We actually adjusted our forecasts to take that into account, and this business has been trading in line or slightly ahead of those forecasts. We have noticed a big pickup recently since the work from home instructions have been lifted, and the inbound inquiries. And as you'd imagine, we had some pent up demand from last year as well. The deals that they hadn't actually gone away; they were just put on ice until business had a clear idea when they're permanently back in the office. We've extended the range of solutions within ANK. The central theme is around smart working places in its most general sense. So it's the sensors in the ceiling, things like the meeting room panels, just like Evoco NASO. And we've picked up some new product lines, which I think is very exciting. And it's very much a one-stop shop now for our partners to come to us and say, I've got a solution, I've got a customer, and the solution is a bit of software, which may be Space Connect. And then they also need 100 sensors and 20 meeting room panels, and they can get everything from ANK. So that partner network we've seen come back to life as we moved into the new year, and it was obvious that everyone was starting to head back to the office. So basically we're looking to grow ANK again this year from the base last year. You can see that the revenues did decline. Even on the decline, as a business, it's not a draw or a drag on our overall business, in the sense that it's not loss making. If it made a loss, it'll be small, in the low hundreds of thousands. It's not cash consumptive. Now, the contrary to that, of course, is that the revenues are less predictable, because they're sort of 90% transactional revenues. But we have good forward visibility around pipeline and projects coming down the line. We're planning to increase our professional services revenue, which is obviously higher margin. But even as a business as a whole, the ANK business generates good margins, anywhere from 25 to 32%. So a lot of people, when they hear hardware, they assume that it's just a 10% margin business, which it isn't in this case. In terms of where we go from here, I mean, the overarching message is keep doing what we're doing. I mean, ultimately here, we're talking here about building a business that we believe will be worth £5 a share, a year or two from now. And the logic behind that number is very much grounded in the forecasts that are out there. And if you were to take our exit ARR in the next financial year, and you were to apply the same multiple, say, that was paid for Sign-In App, one of our smaller competitors here in the UK, where it was taken out for just in the autumn, you come back to something in the region of a £4.50 share price. And that's just a sample size of one of a UK-based business. So the key really is we need to ensure that we keep the ARR momentum. The forecasts that are out there, I think, are suggesting lower growth in ARR, not 50% year on year, but still 30% plus. So if we keep doing that, we'll get to that ultimate destination. Sitting within that overarching strategy, then we've got a number of particular initiatives that we think will actually give us upside. At the moment, we've got customers in 70 countries, but we've got a customer, say, in Korea, they're using the English language product with the English language backend, even though the visitors that come to reception will see a Korean front end. When we conducted an exercise a few years ago in Holland, what became apparent very quickly in that market is that if we're serious about going to a non-English speaking market, everything has got to be in the local language, not just the front end that the customer see, the end user sees, but also the back end where their administrators go to set up the system and set up, and then the support that they engage with as well. They wanted that to be in local language. We see big opportunities in the Far East. I mean, those countries in particular are less affected by COVID than we've been over here. And we've seen our customers grow, albeit selling our standard English language product. And our strategy for this year is to really get that footprint out there. And we're going to start with one non-English speaking market in the not too distant future. We'll announce it as and when that launches. We'll make you aware of it. If that works well, we haven't factored anything into our numbers for that, but if it works well, it then starts to give us a template that we can rapidly accelerate into other markets. It's taken us about a year and a half to actually localize the underlying platform. We launched in-region hosting back in the autumn, which was a big piece of work. But that means now if we sign someone in Malaysia, then they can opt to have their data stored in Singapore or wherever. So that was a key part of the internationalization of the product. So once we've got this hard work out of the way, the actual incremental work required for each market is actually is relatively small, i.e. it's in weeks or low numbers of months, not 6 months or a year plus or whatever. But again, to stress that we haven't made any assumptions about international growth in any of the forecasts that are out there. Obviously, selling more to existing customers. We implemented a price increase last year, and we'll have a customer who might be up for it, might be on an annual plan. They were made aware last August that their price is going up, and they've sort of understood the reasons why. They're happy to carry on working with us, but we won't see the financial benefit of that until next August when their plan renews. So we'll see an element of that coming through this year. What we have done as well is start to put a lot of our new features going into our business and enterprise level plans. So basically weaning people off the off starter plans, and we've had almost like a natural rebasing of our base over the last year. That when we lose customers, they tend to be starter. When we bring customers in, they're on the new price plans, but also they tend to migrate up plans because they need features that are only available in those plans. And that's irrespective of size of customer. You could have a sophisticated user who might only have 50 staff that years ago would have just gone for a starter plan by default. Now, because they wanted to integrate with Active Directory or something like that, will have to go to business or enterprise to get the same functionality. And because we sell to a lot of white collar businesses, the incremental amount that they pay is small in their eyes. Obviously, multi-location, we've got a base of 4,700 customers, and I'd be the first to admit that we haven't been the best at exploiting that. We've got a conscious change underway now to look at how we can expand, and we've seen some really good examples of that recently. Vestas, who are one of the world's largest wind farm operators, we had, I think, 4 or 5 locations in Australia. During the Australian lockdown, we increased that to, I think, about 50 or 55 sites. And we can see lots of those opportunities. And as you'd imagine, the benefit of that is the CAC is so much lower because we're not spending external marketing dollars to get to a customer where we've already got internal reference. And in terms of new business sales, then we're proactively going after large multi-location organizations. They're obviously very high ARPU customers for us when we get them on board. And obviously carrying on with Swipe Down desks. You know, I think we mentioned numbers in the past. If you get to 100, 200 desk customers, the ARR value of those is usually significant compared to signing maybe 500 visitor customers or even more than that. So we want to keep that pushing on, and we're having good success on that so far, which again is very encouraging. In terms of Space Connect, we don't plan to keep expanding the partner network. We've been growing it over the last year. If you do see growth in the next year, it's probably going to be in North America. We see big opportunities there, but we're not talking about opening up lots more partners here or in the Far East. We've got the ones we have are very good, and we've found a way of working with them and service them really well. What we want to do now is get the channel that we have working well for us. And it's been encouraging recently to see that as we've come out of the sort of the whole COVID drama, that a lot of the partners are getting more engaged. They're adding lots of opportunities to the pipeline simply because their customers in turn are actually returning to the office. And obviously Evoco NASO sales is going to be really important for us this year. There's a question that appeared on the screen there. I think it might be a good opportunity to answer that now in the context of NASO. But we've when we made that announcement back in the autumn about NASO, we in turn then we took our numbers back, and now that's those numbers are basically predicated on about 1,000 or 1,200 unit sales a year, which is a tiny number. In cash terms, it's probably about 120,000, 130,000 pounds. NASO's plans originally were 30,000. Even now, they still talk of 18,000 plus. And we know for a fact that they've actually got that amount of units physically in stock in Sweden. So we've got a really low rebased number now. And if we start to beat that number, then it obviously it has a huge bearing on the numbers that are in the market. It's early days yet, but the indications are that there's been a progressive build on NASO as we move through the autumn. And the kind of numbers they were delivering, say, in December are much higher than the numbers we budgeted for the rest of the year. But we'd like to see a beat of 3-6 months before we turn around and say, look, we think this is coming back, and it's coming back really strongly. But the important thing really is that we're seeing good momentum there. They're ultimately, their single biggest problem is people have been back in the office, and they've got two big markets, obviously the main markets in Europe combined with the US. And if people aren't in the offices, they're not buying meeting room panels. That's the bottom line. They might want desk software, but meeting room panels become a low priority. We've seen that ourselves from our experience in A&K, and they're definitely feeling it. But as businesses are returning, we expect to see that there'll be an uptick in sales. But at the moment, I think hitting the baseline number we've got in there, I think is very doable. Beating it, I think I think there's a strong likelihood, but we'd like to see that momentum over a period of months before we decide to make any adjustments to forecasts or change sentiment. So cautious optimism is the message, but well below the ambitions that NASO have for the product. In terms of A&K, this business, as I explained earlier, is focused very much in the UK. Now, what we have been doing is actually bringing in more technology solutions around space management, and all of those come with a SaaS offering, which in turn means that we start to build a recurring revenue with A&K. Also then by increasing professional services and bringing more software, we increase the overall margins in that business. And we've, in addition to A&K being its own entity, and again, I'll emphasize that it's not a financial drag on the business. It's not consuming cash, and it's not loss making to the extent that impacts the overall group. It also provides a sort of a central function, or contributes to a central function, or a support desk for both Swipe Down and Space Connectors, now based out of Mildenhall. We've got a great team there. They're servicing customers from West or East Coast US all the ways across to the Middle East. And the chap who actually drives that support desk actually is also responsible for or support people based down in New Zealand, and that's, so we're running them as one team. We run all of our sales for Space Connect out of there, along with the dealer support and technical support. So and then Swipe Down UK sales are based out of there, and that's in a building that's actually owned by us, so we're not paying expensive rents. And in a part of the market, we find it good to, we can get really good people, and we're not paying the premiums you'd pay if we were based in around Greater London, for example. There's been an awful lot of market activity over the last 6 months, really, and even the last 3 months. That grid in the middle of the screen there is actually the G2 grid for visitor management. So they're one of the few people who actually have created a matrix for visitor management. Swipe Down, you can see there is the little orange square on the far right. Anything that's got a circle around it is someone who's been recently taken out, or there's been major activity around investment or PE involvement. So you can see there now, there's very much fewer assets in the market for businesses who are interested in growing their international footprint around workspace management. So that's the first thing. The second thing is that the valuations that these businesses are attracting are phenomenal, right? Way beyond what we'd expect to see in the UK here. If you look at something like Envoy on the top right, a new entrant. If you asked us 6 months ago, name the 5 consolidators, we definitely wouldn't have named Brookfield, who are obviously a major property fund business from the US, as one of those. But they've got a specialist tech investment fund now that's, I think it's got $500 million in it, and they're just increasing it to $1 billion. And Brookfield are actually started to buy tech businesses, and they're not interested. They're not less interested in size and more interested in what they can, how fast they can grow them. Now, ultimately, Brookfield's portfolio is 220,000 office spaces around the globe, so phenomenal size estate. Now, they invested in Envoy at a 1.4 million valuation just in January. They invested 115 million there, as you see on the screen. Now, that in itself is a phenomenal number. And one of the comments we had recently is, oh, maybe that these people are much bigger than us. They're not really. I mean, in our view, I mean, Envoy boasts 10,000 customers. Now, we don't know how many of those are freemium or how many are paying. We've got 4,700. We think their revenues, because it's not public knowledge, we think their revenues are probably in the $15 to $20 million range. And if you think of our current market cap today as a group, it's definitely not anywhere close to the kind of multiples that Envoy was attracting. Sign In App, our UK competitor, they were taken out in the autumn at 15 times ARR. You apply that valuation to our business, as I said, for next financial year, the exit ARR, then you're getting very close to that £5 share price. So I think Proxy Click isn't much bigger than us in either turnover, and in fact in customers, I think they've got about 2,000 customers. They were acquired by Condeco, who in turn themselves were actually acquired by Thoma Bravo and JMI back in August. So there's a lot of consolidation going on. There's really interesting prices being paid, and there's fewer and fewer assets of any quality to pick up in the market. Now, we believe that by sort of growing our business in the Far East and getting a decent local country footprint in a number of markets will give us a strategic value that a lot of these businesses won't necessarily be focusing on. We know your typical US SaaS business talks about being global, but actually in many cases, it'll be 95% US and 5% rest of the world, generally following the English-speaking market. So that's one area that we can put up as a defense against anyone who would sort of want to attack us. And on the other hand, a way of increasing the value of the business. Because of our size, we have the agility to move really, really quickly. We've proven that through COVID. We were able to get functionality out in a month or 6 weeks, when we know our competitors took the best part of 6 or 8 months to get the same functionality out. And we use all of those things as differentiators, aside from the standard ease of use and speed of deployment, value for money, that were also key parts of our strategy to protect ourselves against competition. So yeah, so lots of activity basically, and we think at the right time we'll be engaging with an acquirer, probably from North America, possibly one of the big consolidators who really wants to accelerate their footprint, and we can give them a business that's a great business to scale with time.
So just briefly on the current trading, we begin the year with a good order book and pipeline, especially here in the UK. We've seen orders coming in at the beginning of this financial year, which have been sitting in the pipeline for 2 years, in particular for A&K. They just entered the pipeline just before the pandemic, and they've been waiting there as we go through the pandemic, and they're now being placed. So we think we've got a good start to the new year, and as the work from home restrictions become less of a thing and companies go back to the office, we think the businesses will do well.
And in conclusion, I think, I won't go over it all. I think I covered it in the last slide there, but we've really, we continue to have a really exciting business. Obviously, it's really upsetting for you as shareholders and for us as a management team to make the announcement we had to do in October. And one of the unfortunate side effects of that is that it took the spotlight away from the rest of the business, which, as you've seen now, and this is the first time we've been able to publicize it, was actually carrying on its own way, building the value in the business. And what we want to do really now is to, I suppose, bring that focus back into that's the bits of the business that outside of NASO, which is the vast majority of what we're doing, is doing really, really well, with strong momentum going into the new financial year that we started on the 1st of February. So that sort of concludes our presentation.
That's great. Christian, Frank, thank you very much indeed for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the questions submitted already, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Now, Frank, Christian, obviously investors had the ability to pre-submit questions ahead of today's meeting, so perhaps we could look at those before looking at those that have come in the live meeting. The first one reads as follows: A&K is having a drag on revenue. Companies are adapting and still using meeting rooms. Is A&K adapting as well, or will it need to be sold off?
Yeah, I mean, A&K has definitely been adapting. We've increased the product range. You might remember that business when we bought it was 95% sort of audio-visual, selling screens and projectors and that kind of thing. We do virtually none of that now. And if you look at the website there, you can see that the emphasis is very much about workplace automation and introducing smart technology around sensors. We carry a number of sensor lines. The idea is to offer a best-of-breed approach to our customers. And in the case of A&K, our customers are about 500 resellers around the UK. So in that respect, it's definitely adapting. Secondly, A&K actually adds a lot of value to the group because through the network, we have a number of those partners who resell Space Connect, and we want to make sure that we maintain that. And they've been long-standing customers of A&K, so they're really, really important. It's a drag on the revenue in the sense the quality of revenues in A&K is lower because it's predominantly transactional rather than recurring. But equally, it makes a good contribution. And more importantly, it's not loss making, and if it is, it's not to any large extent. And if we keep pushing on the numbers we're looking for this year, it'll generate a contribution. Unfortunately, it is the one bit of our business that was most impacted by COVID, which is simply because people aren't in the offices. We've got a number of projects there now that have been delayed since October, November. We know they're coming back on stream now that people have a clear idea when they're actually heading back. So, as I say, when you look at it on the surface, it might look like it's a drag. Behind the scenes, it's not really. Equally, though, our strategy for the future is to move more and more to being exclusively a software business. And we as a management team will keep that business constantly under review, and then from that will dictate what actually happens.
That's great. Thank you very much indeed, Frank. If I may turn to the next question, reopening should provide a nice tailwind for the business if it continues in 2022. Costs for the business should also tick higher. I was wondering when you expect to be cash flow break even.
So we have forecasts obviously going forward for quite a while, and in those forecasts we don't have any need to raise any new cash. You see from where we were this year, we've burnt through about 500,000, 600,000 since July. You can see from the broker notes that we expect to continue to burning some cash in the next year and start to be cash generative the year after. Swiped-on is already cash generative. Space Connect will take a bit more time to get to that point, and A&K we expect as things open up to be EBITDA positive this year. We have good predictability in terms of our revenues from both Space Connect and Swiped-on. We know exactly where we are, and we can forecast quite well where the businesses are going to go. And those businesses also have a lot of customers who pay upfront annually in advance. So Swiped-on, around 70% of our customers pay annually in advance. Space Connect, pretty much all of our customers pay annually in advance. And when we look at the Avoco side of things, a lot of those licenses which we sell for that product are 3 years or 5 years, which are paid upfront as well. So looking at that, we think that we have the cash that we need going forward.
That's great, Christian. Thank you for that. If I may, Frank, turn to the next one. It's do you expect a big change in the level of demand now people are starting to return to the office?
Yes, very much so. I think Chris pointed out in some of the charts there where you could actually see things kicking up as soon as we came out of a lockdown as we moved through last year, and I think that's definitely the case. We have noticed a big pickup since January, in particular since the work from home edict was lifted. Now, it isn't a flick of the switch type increase in demand, but what we do see is an initial increase in inquiries, reactivation of deals and quotations that have been on the go since last year. And it's been progressive since the middle of January now. So each few weeks, there's more and more inquiries, the orders are coming through. So I think it'll be probably more gradual than people realize, but actually it's very, very solid now. And just speaking to our customers and partners, you can see that they are consciously planning around being back in the office in a very large way. There's been lots of regional differences. I mean, Australia last year, whilst we did well there financially, it was actually selling more to existing customers. We did very little in new customer growth in Australia. On the other hand, since October, with Swipe Down in particular, Australia has just gone crazy for us. It's been one of our strongest performing markets. And we've seen a similar uptick as well with Space Connect, where we've got a number of partners there. So I think the main message is, yes, absolutely a change in demand, and and ultimately it does highlight the single biggest risk in our business as it is for many, which is, heaven forbid, we have to go back into another lockdown at some point in the future. But for now, I think we're seeing good interest in the US, in Australia, the UK most definitely. And less so in some of the Far Eastern markets, because they've been sort of very much business as usual through a lot of this.
Thanks very much indeed, Frank. Turning to a question, really, I think you touched on around the slides about market competitors, so I'll bring that up for you now. But the question reads as follows. At most of these meetings, you keep reiterating that SmartSpace will be worth £5 and that we are so cheap compared to our peers. Surely actions speak louder than words, and why do the board not buy more shares than £10,000 or 10,000 shares?
It's an interesting question. I mean, I think I've headed off the £5 share price one already. So basically use the exit ARR the next financial year, and if we can deliver on that and we apply a sensible multiple, we're getting back to that £5. So it's not I suppose not a figment of our imagination. It's based on science. Equally, it relies on us doing our job between now and then, and that's always been our strategy. I mean, our primary motivation, and what Guy, the chairman, and Philip, the other non-exec, have done with our comp plan is to get us completely aligned with shareholders. Now, Chris and I, in particular, are on option plans that are really dependent on us to get to sort of £4, £5 to realise any real value for us, and especially considering the work that we've put in over the last few years. And it hasn't been an easy journey with this business, right from our first involvement years and years ago. And ultimately we should be driven by that option plan, and not necessarily by how many shares that we actually buy in the business. We wanted to show a commitment, and we did that, and we did it collectively as a group. But I would say, look at our option plans. Look at the fact that we don't take premium salaries. Our options as they sit today are at £1.32. Now, we could have easily rebased those options at 70p, 65p last week. We haven't done that, simply because we as a group and a management team and as a board believe that value is actually is where we can get the business to. And I suppose we want that to be a mark of what keeps us focused on the business, and ultimately what illustrates what illustrates our commitment to getting to that end destination. And even at a very personal level, I remember when years and years ago, when my involvement kicked off in this business, and it culminated in a requisition for an EGM by a major shareholder who was also director of the company. And he basically wanted to get rid of myself and another non-exec on the basis we were destroying shareholder value back then. And at the time, the advice that I was given personally by some of the shareholders who'd asked me to get involved was, get out of there, because these things are really nasty. And what actually changed my mind at the time was I heard a story about a lady who had invested her life savings, £68,000 worth, in comms as it was then, and she invested at 11p. The day we were having that conversation, we were at 0.5p. Now, ultimately, my motivation for staying and actually taking multiple kickings, to be honest, in the subsequent sort of 6 and 12 months, from everyone from our bankers to our customers to shareholders, was the fact that if my job at the time as a non-exec was to look after shareholders' interests. Now, fundamentally, at a personal level, that hasn't changed with me. I am more interested in my reputation and the fact that I want to do a good job here for shareholders. And if I get rewarded on the back of that because I've delivered value and it comes through the share options, I think that's a fair quid pro quo. And that's the motivation that I need every day to sort of get stuck in. And I know it drives Chris as well.
Absolutely.
Yeah.
That's great. Thank you, Frank. A couple more pre-submitted questions and then we'll talk to some of the live ones. But I noticed a question from Chris G that's come in the live meeting about cash raisings. Fits nicely with the next question. Canaccord's forecast show the company remaining a net cash position despite ongoing losses, courtesy of an extremely strong forecast net working capital inflows. How certain are you of these inflows? If these inflows disappoint, is debt funding available to the company and at a reasonable cost, or would the company need to issue more equity to raise additional cash?
I think just as I said just before, we have cash flow forecasts going forward for 2 to 3 years, and we don't have any assumptions in there in terms of issuing any new shares. Our cash inflows from Swiped On and Space Connect are very predictable. We do have certain growth assumptions in there, but we think that they're realistic assumptions that we have in that. We're assuming quite conservative for Evoco and ASO in those assumptions. And so there is potential upside there as well from that. I think that the positive working capital assumptions, which you see in the broker notes, largely come from the fact that we do get our subscriptions annually in advance. And as I mentioned before, also with Evoco, we get some of our subscriptions 3 to 5 years in advance as well. So we are confident that we have the resources in place.
That's great. Thank you. And finally, if I may, the final pre-submitted question, what makes the company's products superior to the competition? Is the company seeing new competitors coming into the market?
Yeah, we've got 3 fundamental differentiators around product. One is ease of use. So all our products, even Space Connect, which is a much broader product in terms of functionality, can be configured by our users. Not all of our competitors offer that. Secondly, is speed of deployment. Someone was telling me there before Christmas, we got a customer that came to us from Softcat, and we did the demo on Tuesday, got the order on Thursday, and we had them live on Monday. So I don't believe many of our competitors come anywhere close to us. I mean, you hear implementation times of 3 to 6 months for some of them. And the last bit is value for money, which you could argue is actually not very defensible because anyone can drop their price. But if we can maintain that price advantage, is really important. If you were to take Envoy, for example, on a like-for-like basis, our enterprise product, and they're offering, in the US, we're coming in, say, roughly $199 US. They're at $299. So despite the fact we put our prices up, we've still got a big price advantage. Sitting around that, then, the most defensible thing we have is customer service. You know, we haven't mentioned it here, but we always quoted our NPS scores, which is consistently in the sort of 50s, 60s and above, which is really, really high for a business of our size. And what we've tried to do now is make sure that persists right across all our business. And again, that's something that you can have a big business with lots of marketing dollars, but if you don't look after your customers, you've got a big problem. So that sort of comes in very strongly. And the biggest thing we have then is obviously agility, our ability to turn out new functionality really, really quickly. The Far East, for example, is a good case in point. I mean, whilst it's taken us a while to get to this stage, if we were to roll out Korea next month and that worked really well, there's nothing at all stopping us to go into 3 markets at the same time. It's not going to consume a huge amount of cash. We can get the products localized really quickly and get the infrastructure in place. I'm not convinced that all our competitors actually have that agility. And then in terms of development, in terms of particular functionality, we've got some very interesting features in our products that competitors don't have. Maybe they would copy them with time. But when you're little like us, the best form of strategic defense is actually innovation. And the key for us then is don't stop on the innovation. Now, that manifests itself into numbers and that, oh, you got your product built, why don't you just take down your dev costs? And that would give us a short-term bump, but it wouldn't mean that we would have a business that's defensible in a year or 2 years' time. And whilst we're not talking about investing huge amounts more in dev, equally, we want to continue to invest in it. And especially as we move through COVID, we've introduced functionality there now that took us about a month or 8 weeks just recently, where we give customers the ability to read COVID passports, for example. And again, even last year, the contactless check-in, we had that out in a month or 6 weeks. Our competitors did, as many struggled to get it out even by the end of 2020. So I think innovation, speed of change, and constantly sort of being one step ahead of the competition are probably the sort of secondary reasons why we're different to the competition.
That's great. Thank you very much indeed. And that concludes the pre-submitted questions. So thank you to everybody that took the time to submit those in advance. If I may turn to the live questions, Christian, Frank, if you could open up that Q&A tab, you'll see there's a number of questions submitted from investors today. Again, thank you to you guys. Perhaps I could just hand back to you to read out those questions and give a response where it's appropriate to do so. And I'll pick up from you at the end.
If we start with this one, which is, can you confirm your net cash position, and in the medium term, what's the ARR opportunity from Evoco on our most prudent assumptions? Maybe Chris.
Sure. So we've got a small amount of debt. We have a mortgage on our building in Mildenhall, so it's about £380,000, I think it is. So our net cash is £2.4 million. Most prudent, so the ARR opportunity for Evoco, in our very conservative and cautious assumptions we have at the moment, we're looking at a growth in ARR for next year of around about £100,000. So that's a very cautious assumption which we've got in there. I think, as Frank mentions, Evoco have assumptions which are 18 times higher than what we have. So I guess that gives you the potential range for that opportunity.
And next one there is, how big is the opportunity in South Korea and Asia in general? The honest answer is we don't know. We could have spent a lot of money on very detailed research that told us how many businesses are there. I'm a firm believer that sometimes it's easier, cheaper and faster to go and do it in real terms and get a definitive answer. And that ultimate definitive answer is, are people willing to pay real money for your product? Our suspicion, based on the customers we have in Korea, if you think South Korea is not dissimilar in size to the UK, we could end up with 500, 1,000, 2,000 customers. We've done, as I say, we've made no assumptions in our planning. What we do know about that market, though, is the cost of marketing in there is so much less than it is in the US. You take some of our most common Google AdWords, and some of those are going at $20 a click, and sometimes you might need 50 clicks to even get a trialing customer, and you might then need extra, you need 10 trialing, to get one customer, you might need four trialists. On a like-for-like basis, some of those search terms are coming in at anywhere from 50 cents to $1 in that market. Now, the dynamics in somewhere like South Korea is very different. Google isn't the dominant search engine. They've got two big ones, Naver and DAM. So it's going to be a sort of a leap in the dark for us. But the view is, let's go in and try it. In terms of ambition, it's really back then to what we would put as a sensible number. If you go back to right now, say we have broadly or roughly 2,000 customers in the US. Let's say we were to double that base to 4,000. The cost of marketing dollars to get there will be significant. If we were to go across Asia, we've identified, I think, 12 or 13 markets out there. If we were to get into 10 of those and we only had 200 customers each, we'd achieve that growth, but we'd be doing it at a fraction of the marketing costs. Now, at the moment, that's all sales speak coming from the sales guy. So please take it for the optimism that's built into it. The reality will become apparent very, very quickly over the next few months. And I'd much prefer to go and base a plan knowing that we spent X and got Y in the Korean market. Now let's scale that over the next year. In the event that it isn't anyway as good as we suspect it could be, the fact that we go in there and stay there in a maintenance mode or we withdraw, none of that is going to do any kind of big damage to our business. On the other hand, if it is successful, and knowing our enthusiasm and ambition, we'll want to accelerate it as quickly as we can. And I believe that what we're working on now, we've got ourselves a really good footprint to work our way into a lot of those other markets. And obviously, if we embark on non-English speaking markets, then we shouldn't be confining our ambitions just to the Far East. We're doing that now simply because geographically and time zone wise it's relatively close to New Zealand, so we can service it out of there. The markets are less affected by COVID and all those sorts of things. But for us, really, if Korea works well and then subsequent 2 or 3 markets work well, it'll probably form the cornerstone of our strategy over the next few years, rather than saying spending more and more marketing dollars, which is going to get progressively more expensive. Those $20 clicks were costing us maybe $2 or $3 when we bought Swiped On originally. So the inflation in sort of AdWords clicks has been extensive. It's come back a little bit now compared to where it was, say, last year, but it's still expensive relative to those markets. And more importantly, then we're generally going up against small local competitors as against big players with big marketing budgets like Envoy. But so yeah, we think there's great potential there. We're now moving into an active research phase where we'll end up with some good hard results as against a report that says there could be a great market in Korea, or maybe not.
This one. Yeah. Which of your divisions do you see growing fastest in 2022?
Yeah.
So I think we see growth in all of them, in Swiped On and in Space Connect and in H&K, as well as it exits as we exit the pandemic. Probably the fastest growing one is still going to be Swiped On. As Frank mentioned there, we've got good opportunities going into Korea, and certainly from an ARR growth perspective, we still have the price increase which we implemented this year. That's still feeding through into the customer base. And so that will continue to drive growth in that business as well.
Great. Next one here says, it does seem that business is very undervalued. In this case, have you already received approaches to be acquired? We haven't, to the extent that there's been something that we need to take to shareholders, and we'll obviously have to announce it accordingly. On the other hand, probably there's not a week goes by where I don't get these speculative inbound emails from someone sitting in a PE firm in the US telling us about what a great job they can do and help us expand our business. Some of that is really badly researched to the point at which they probably don't even know we're a public company and can't have those discussions, and others a bit more sophisticated. Now, I'm long enough in the tooth to know, and I've made the mistakes myself years ago, that you start to engage in all of these, then it takes up an awful lot of your time and takes our mind away from the job in hand. I don't think it's the right time to engage with anyone right now. I mean, you take our current share price, what will people give us, a 20, 30, 40% premium or something? It's nowhere near what we feel this business is worth. And we would definitely, if we had an approach at this level, we probably wouldn't be recommending it to shareholders. Our view really now is to keep our heads down. We'll obviously engage where we feel that there's someone serious, be very dismissive of anyone that we feel is just a tire kicker. And in the meantime, the other big thing, and it's something that's really important for myself and Chris and the board in general, is to make sure that those big players are aware of who we are and where we are. And if we've demonstrated anything over the last few years, is our ability to do that as a management team. As we restructure the various businesses, we're able to sell and indeed buy businesses as well. So that's again where our experience will come to the fore.
Good question here. You are over 7,000 locations now. Should that be the key metric to be followed going forward as opposed to customers? Secondly, where could you increase your total locations if you focus on the current customer base? Absolutely, location should be the numbers which are the key metric which is followed. I think that's key for us. We're seeing a lot more multi-location customers come into the business, and I think that is definitely the key metric to look at going forward. We do focus on our existing customer base at the moment. We're seeing a lot of we're targeting that, as Frank mentioned earlier, with investors and a lot of our other customers, where we're trying to specifically target those customers where they have one or two sites with us and try and get them to increase that going forward.
I've actually got one or two live examples of that. I mentioned Vestas earlier, the wind farm company. They're the world's largest wind farm operator, and we've just got a big footprint in Australia. You start to look at where they are around the globe, that surely has got to be a focus for us. Another really good example is a logistics firm. It's not DHL. We've got a few in our portfolio. Now they came to us individually. We didn't do a central deal with their head office, but we're in about 30 of their locations in the UK. When we started to analyze that business, and not because we were selling centrally, but because we were trying to sort of get a sense of the scale of the market, we discovered that even on their website, they showed 70 locations in the UK. In fact, they're probably something like 150. But then as you dig a bit deeper, we find that 400 in the US, and I've just learned in the last few hours actually that we've got 230 in France. Now, and we've already got two customers in their French network actually using Swiped On, and they were individual sites who came back to us. So straight away there's a location opportunity of that's running into many hundreds, all from an existing customer. They're already a case study on our website, and we've got internal references, which ultimately is the best form of selling you could have, a selling opportunity you could create. What's even more interesting is the cost of acquisition. Now, our best value cost of acquisition is through some of the app stores. It's about $300. Typically through AdWords, it could be anywhere from sort of up around 700 to 1,000, and it could be higher than that even through something like Captera. We ran a campaign recently targeting these sites in the UK for this logistics business that we didn't actually deal with directly. We got 3 orders, and the campaign cost us £150 using, funnily enough, direct mail, something that we hadn't seen much of in the last few years. And the CAC for that campaign was about $30, so an awful lot less than elsewhere. So clearly locations are huge, but actually locations from existing customers, and we don't need to get to thousands of our customers. We only need 10, 15, 20, 30 with multiple location opportunities like those. What we've got to get good at is how we build the data for those customers and how we get the message out to them and get them converted. Yeah. Next one there is how we're developing sales channels in non-English speaking countries. Now bear in mind that our only we have channel partners in Space Connect. We've got about 100 that sell around the globe, but that's a very different channel proposition. They tend to be generally smaller SaaS referral partners as against system integrators. Our main channel activity is in Space Connect, and in Space Connect then 100% of our sales are through channel. Now, we've got a big part. We've got 2 partners in Asia right now that will constitute non-English speaking countries, and we're not targeting markets that aren't interested in selling English language product, because Space Connect isn't ready for that market. And servicing partners at that level then brings with it its own challenges, because their expectation is you have someone who can actually speak their local language sitting in your office who can help service them with technical queries. So what we have done is focused on a small number. We've got someone like ESCO, but they've got offices dotted all over the Far East. We ran our first seminar for their office in the Philippines just last week, and they had 40 prospective customers come on that call. So that's really how we support those partners. We give them lots of collateral and lots of help. We don't have big budgets to sort of stimulate demand in those countries. We're relying on them going out to their customer base. Our job is to give them the case studies and the ROI documents and the general thought leadership pieces that we publish. But we're really going to focus on the English-speaking markets. We mentioned there earlier, we got partners in Belgium and Poland. They're actually selling the English language product to those, and we're not constantly going after new partners in those. Where you may see growth is obviously in the US, which I alluded to earlier, but we're not planning to sort of move much beyond the territories that we're in for now. Just focus on getting the partners we have working really, really well.
One here, we noticed a slowdown in locations in December 2021. Could you give us more color to that? I don't think there's any specific slowdown in December. I think we still see continued growth in locations. We see it both from new customers, also from our existing customer base who are adding new locations on. And I think that we're confident that we can continue to grow those locations going forward through the various different channels which we've got, both by targeting our existing customer base, by going into new markets like Frank mentioned with South Korea, and also our existing markets as well.
The next one here is, are you looking at expanding into South America, especially as virtually all countries speak Spanish with the exception of Brazil? Absolutely. I mean, once we get this model proven that we can sort of have a really good template for getting to a market quickly and relatively cheaply, then it makes sense to exploit that and not restrict our activities just to the Far East. The key then is about balance, to do it in a way that we do it really, really well. By coincidence, we had someone who worked for us in Spike Don, who was a really, really great person, and we were sad to lose her, but her mum was ill back in Brazil, and she's relocated back there. She'd work with us in a heartbeat tomorrow morning, and I could see us getting someone like that active on the ground as and when we're ready. The next one there is, given the high marketing dollars cost in the US, is this a threat to growth? It would be if all our growth was predicated on exploiting the US. On the other hand, though, if you have an opportunity to go to markets that are left of field, where there's not as much competition, why would you commit all your resources to, and we appreciate the US is a fantastic market, and we don't get price pushback in the US because everybody we see sort of will quote Envoy. We know we're cheaper than them. The problem is, though, that you got a lot of PE funded businesses in there with big marketing budgets, not all wisely spent in our view, but ultimately what it does is push the price up. So we've got 3 people based in the US and in Texas. We've got a great base there. We've got great upsell opportunities. So we continue the growth there. The key, though, is if we can find that our marketing dollars go further in other markets, then clearly we'd move our resources there. But we wouldn't take we may not look to accelerate in the US, but we wouldn't take our foot off the gas there completely either, you know.
That's great.
So I think that was the question.
Yep, absolutely. Frank, Christian, thank you so much. And thank you once again for all the engagement from investors who have submitted questions this morning. And perfect timing, Frank, as we hit the hour. So thank you. I'll shortly redirect investors to provide you with their thoughts and expectations and their feedback. But before doing so, Frank, I wonder if I could just hand back to you just for a few closing comments to wrap up with. And then, as I say, I'll redirect investors to give you their thoughts and expectations.
So I said the most important thing is thank you very much for your time this morning. We really appreciate it, and it's great for us to be able to bring a bit more detail back to where we're sitting at. And our ambition was to do that as early as we could once we closed the year. We've had a strong year, despite the fact there's been lots of headwinds. I mean, you know, the lockdowns here and around the globe have impacted our business. But despite that, we've got strong growth. Our faith and belief in the business is undiminished. In fact, more so, we think that there's even bigger opportunities out there. And since we've crossed some major development thresholds in terms of internationalization now, it sort of opens up some amazing opportunities. And we've got a fantastic asset in the sense that we've got great customers, great loyalty. And we've also got great infrastructure to have a dedicated software dev team now operating out of New Zealand, which is in the scheme of things is seen as very much a safe haven. I think we're very, very fortunate, and it's building strategic value in the business. So I think really we just got to get on now over the next 2 years, hunker down, deliver on what we said in this presentation, and we'll get to that destination, albeit slightly late, but equally a major world pandemic in the meantime wasn't going to accelerate things. So and again, thank you very much.
That's great. Thank you very much, Christian and Frank, for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SmartSpace Software, we'd like to thank you very much indeed for attending today's presentation, and good afternoon to you all.